In this video, I am analyzing companies which are into manufacturing of cement. The companies I am analyzing today are Ultratech Cement, Shree Cement, Ambuja, ACC and JK Cements. Only Ambuja and ACC have TTM values, that is 12 trailing month values, and Ultratech, Shree Cement and JK all have their results up to date till 2019 March. As in when we come to a ratio where 2018 values are applied, I'll be informing about the same. Ultratech Cement's current market price is 4,523 and its face value is 10. All group companies' face values are 10 except Ambuja, whose face value is 2. That is the actual price. Then if we multiply the face value by 5 to equalize it with the other group companies, we'll also have to multiply it by 5 with the price. So that would come down to somewhere around 1000 rupees. So if you have to compare price wise, JK Cement has fallen the most at 985 rupees. It's the cheapest one available at 985, followed by somewhere around Ambuja and ACC. Ultratech is the second highest priced company compared with the face value. Shree Cement is very expensive at 21,100 rupees per share. This would also happen if the company's total shares floating in the market is very less. Next, let us look at how much these shares have fallen from their 52 weeks high. That would suggest the weakness or the strength of the stock. The more the fall, the weaker the price or the weaker the stock is. Ultratech Cement has fallen 7.8% and most of these companies have fallen less than 15% from their 52 weeks high. So which is a good sign. The highest fall was seen in both Ambuja and ACC at 12% from their respective 1 year back price. Next, let us look at the earnings yield of these companies. It measures the profit that the companies have earned on each share and comparing that with the current share price of the stock. Ultratech Cement's yield percentage was 2%. Shree Cement gave 1.3% earnings yield. The highest earnings yield was seen in both ACC as well as Ambuja at 6% and 5.4% for Ambuja. The earnings yield is calculated by comparing the earnings per share, that is 11 rupees, earned on a price of 214 and an earning per share of 92 rupees for ACC on a share price of 1544. That translates to 6% of earnings yield. Here we want it to be as large as possible or as high as possible. Next, let us look at the price earnings multiple of the recent 12 months. This is the current market price compared with the trailing 12 months earnings per share. We already have both the values, price and the 12 trailing months earning, that is 88 rupees. So we see that the price earning multiple is 52 times, which means that as investors we will have to pay 52 times more for the earnings of the company to invest in this particular share. That is, to earn 88 rupees of earnings, investors were paying 4,523 rupees. That is 52 times. Here I don't want to pay more than 25 times. 25 and below is my benchmark. Even Shree Cement current price compared with the latest earnings is available at 67 times its earnings. Earnings were 273 whereas the price was 21,000. So very high multiple for both these scripts. Ambuja and ACC were available at a reasonable 17 and 16 times earnings multiple. JK Cement was slightly higher at 23 times. Here I want it to be as low as possible and preferably below 25 times. Next, we can also compare the current price earning multiple with its averages of the last 5 years and average price earning multiple during the last 3 years. This will help us understand where the current price earning multiple is compared to the 5 years and 3 years average. Ultratex 5 years on average price was quoting 39 times higher than its earnings. In 3 years it was quoting 42 times higher than the earnings, and currently it is quoting at 52 times, which is even higher than the averages. When we are planning to invest in the shares, we would want it first of all to be below 25 times its earnings, and also if possible below its averages of 5 and 3 years. All these data is available from screener.in. If investors are interested, they can go and check out the site. These ratios are available in the peer group comparison. Shree Cement 5 years average price earning was 39 and 3 years average was 46, and the current price earning multiple is even higher than that at available at 67 times. So we cannot buy into scripts which are trading at such high price earning multiple. Compare that with Ambuja's and ACC, whose 5 years and 3 years multiple were slightly above 30, but current price earning multiple are available at 17 and 16 times, which is below the average as well as below 25 times. Same is the case for JK Cement, whose current price earning is below its averages of both 5 and 3 years. Next, we'll look at the price to operating cash flow. This ratio helps us understand, like the price to earnings ratio, where the price is compared to the cash earnings of the company per share basis. That is, how much cash the company has earned through operations on per share basis. Earnings per share would include all expenses, whether cash or non-cash, whereas the cash earning would only include cash from operations coming in or going out. This ratio is much better than price to earnings because cash manipulation cannot be done so easily compared to the earnings, where depreciation rates can be changed to increase or decrease. Where depreciation rates can be increased or decreased to change the profit figure. Here too, we want the price to cash flow or operating cash flow ratio to be below 25 times. Compared to the earnings part, we see both Ultratech and Shree Cement have a very reasonable price to operating cash flow ratio of 24 and 35 times compared with the price earning of 52 and 67 times. So price to cash is much reasonable here. Ambuja Cement, ACC and JK Cement had a price earning multiple of 24, 25 and 10 times. The lowest price to cash ratio was for JK Cement at 10 times, which is the best in the group company. In terms of free cash flow, here we are trying to understand what is the free cash flow with the company after removing out all expenses from the operating activity of the business and also removing out the investment in fixed assets. So whatever remains free for distribution in financing activity, we use that in the free cash flow and compare that with where the price is. Investors can learn about cash flow statement, which is a very important statement, along with the P&L account as well as balance sheet. I would recommend understanding cash flow thoroughly before investing in shares. Here too, we want it to be below 25 times. We don't want to pay more than 25 times the free cash flow of the company. As we can see, most of these companies are trading above 25 times. The highest was Shree Cement at 421 times its free cash flow. This is because the company's free cash flow must be very less compared to the market cap of the company. They must be investing very heavily in buying fixed assets. That is why less free cash flow is with them to distribute or distribute in the financing activity of the business. Other companies also have a very high price to free cash flow ratios. In this case, whichever one is the lowest, Ultratech would be the best score or the best ratio, followed by ACC at 46 times. Next, we'll look at the price to book value. This is the comparison of the current share price with the book value of that particular share. In this case, book value is the value of the share as per the company. So we can use that comparison, what the company is saying the share is worth against what the market participants are saying. Here we want the price to book value ratio to be less than 2.5 times. These are my benchmark values which I take to understand or which I follow to time my entry into the buying of scripts. Ultratech's market price was 4.4 times higher than the share's actual value as per the company. Very high. Even Shree Cement was very high at 7.7 times its book value. ACC and JK were at 2.6 times each. So this too is high. We still need to wait for the price to book value to fall below 2.5 times before we can buy into the script. Ambuja Cement has become the most reasonable in terms of comparing price with book value, and it is available at just 1.9 times its actual shares value. Next, we'll look at the price to sales ratio. This ratio again helps us understand the valuation that we are paying for the shares that we want to buy against the sales that the company has done. So where the price is compared to the sales per share, or if you look at in a complete sales value and compare it with the market cap, we can understand how much the market cap is compared to what the company has done in sales. These are all valuation metrics which helps us understand if we are buying shares at a reasonable price or are we paying very high a price for these variables or against these variables. Ultratech was available at 3.3 times more than what it did in sales last year or latest year of 2019. So for example, if the sales were of 100 CR, this is just an example. If the sales were 100 CR, then the market cap was 3,300 3 and 330 CR. So this is again, we want it to be as low as possible. That is, the market cap has to be very near to what the company has done as sales. That will give us a value buying in these companies. We also have to look at other ratios before we can think about entering into this script. These ratios only help us understand where the price is compared to different variables. Shree Cement is trading at a high multiple of 6.3 times against the sales. Ambuja, ACC and JK Cements are all trading below 2 times its sales. As I said earlier, we want it to be as low as possible, or in other words, the market cap has to be as near to sales. Next, we'll look at the profit growth rate over the past 5 years. These are the CAGR values or compounded growth values. This would help us understand how the company has managed to grow its profit over a period of 5 years. Here we want the profit to grow at the rate of 10% at least year on year over a period of 5 years, as well as over a period of 3 years. Ultratech has managed to grow its profit at the rate of 3% over a period of 5 years. The highest growth was seen in JK Cements, which managed to increase its profit from where it was 5 years back at the rate of 27%. Ambuja Cement also did well by managing to grow its profit at the rate of 13% year on year. In the last 3 years, if we want to look at from the last 3 years, the highest growth rate was seen in both Ambuja as well as JK, growing their sales at the rate of 47%, followed by ACC at 27%. Ultratech and Shree Cement both saw a fall in their profit growth rate by 1.2 and 1.3% each. This is a mild degrowth in profit over a period of 3 years, and it can be ignored also. Also, when we see profits growing over a period of 5 years at a high growth rate of about 20%, it needs to be investigated as to the base profit value or the base year value, or where the profit was 5 years back. If the profit 5 years back was very small, then it would generally inflate the growth rate to such high 47% or 28%. So we need to investigate why the profit has grown, even if it's grown at a high rate, why it is growing at such high rates. Is it just a mirage, or is it really growing at such high rates? And that can be analyzed by looking at the 5-year back value of the profit. Next, we'll look at the price to earnings growth ratio of both 5 and 3 years. This ratio would help us understand the price earning multiple that we are paying for these companies. Is that justified? So, to understand whether we are paying a high price earning multiple or not, we compare that with the profit growth rate of the last 5 years. First of all, in price earning, we are paying something against the earnings of the company, some multiple against the earnings of the company, and we want that earning to grow also at a high rate if we are paying a high multiple. So in case of Ultratech Cement, we were paying 52 times against the earnings of the company, but we are not getting a growth of a high percentage in profit or earnings over the last 5 years. So then this price earning multiple will not be justified, or we can say this is very high. Anyways, it is very high because our benchmark is less than 25 times. In terms of last 3 years, we see there was in fact a fall or a degrowth in profit by 1.2%. Now this PEG is calculated by dividing price earnings of 52 with profit growth rate of 5 years, that is 3. So we get a PEG of 17. Here we want a PEG to be between 0 and 1.5. Whenever the value is between 0 and 1.5, it would signify that the price earning multiple that we have paid for the share, we would be able to recover the capital much faster. To give an example here, since we are paying 52 times more than the earnings, and assuming that the earnings won't change in the future years, that is, the earnings will remain constant every year henceforth, then it would take us 52 years to just recover that capital. But if there is a growth in the earnings, which we can see here, this is the backdated historical growth rate in profit. If we project this over the future years and assuming that it will continue growing at 3% each year, also it will take us a lot of years just to recover our capital. So when we are paying a high price earning multiple, we also want a high profit growth rate over a period of 5 and 3 years each. In fact, in the recent 3 years, the profits have been falling. So we will take, in fact, we would require more years just to recover our profit, our capital invested in this company. So until and unless these values don't increase, the price earning multiple that this stock is commanding is very high. A negative PEG is of course a no-no, because that would indicate a fall in the profit. Shree Cement's PEG was 20 and minus 59, again a very high values. We want it to be below 1.5. The 20 signifies that the price earning multiple that we have paid 67 times against the earnings, we are not getting the earnings growth rate. The earnings is growing only at 3.7%. So how would we justify paying such high price earning multiples? In fact, in the last 3 years, we again see a fall in the profit of minus 1.3%, which would turn the PEG again negative at 59% or 59 times. Ambuja's PEG were very good at 1.3 and 0.4, which again, if we look, it says that price earning multiple that we paid was 17 times against the earnings, but we are getting a good growth rate in profit or earnings at the rate of 13%. In fact, in the recent 3 years, the profit has grown faster at 47%. So that is why the PEG is below 1.5. In terms of for ACC also, the PEG is 2.2 and 0.6. Because the profit had grown at a faster rate of 28% in the recent 3 years, the PEG of 3 years has become better at 0.6. JK Cement's PEG is also very good. So the price earning multiple that we are paying of 23 times is justified. Next, we'll look at the sales growth rate over a period of 5 years, how the sales has been growing year on year throughout the 5 years as well as in last 3 years. We want the sales also to be growing at 10% just like profit. This would again signify that the company's management is very efficient in increasing their sales. Not only that, the sales value would also indicate that there is demand for the company's products. That is why the sales has been increasing over a period of 5 and 3 years. Ultratech has managed to grow its sales over a period of 5 years at the rate of 12%. And most of these companies have managed to grow above 10% except ACC, whose sales has been growing at 6% in the last 5 years. In the recent 3 years, the sales for ACC was 8%, and JK Cement's sales growth rate has fallen to 6.5. So where it was growing at the rate of 12% in the 5 years, in the recent years the sales has slowed down and it's growing only at 6.5%. Ultratech, Shree Cement and Ambuja, all three have managed to grow their sales for both 5 and 3 years at above 10%. Next, let us look at the return on equity of the 5 years and the recent RoE of 2019 or 2018 as the case may be, and how the return on equity has been growing or falling from 5 years. Growing or falling from last 5 years. Let us look at the return on equity. This is the profit that the company is generating on shareholders' money. We are going to look at the 5 years average return on equity and compare it with the recent return on equity. Return on equity benchmark should be 15% and above. Ultratech RoE for the 5 years average was around 10.3. The highest return on equity was by Shree Cement at 16.4% on average, followed by JK Cement at 12%. The lowest return on equity on average was seen for Ambuja, earning just 8.9% on shareholders' money. If we look at the recent RoE, Ultratech was giving a returns of 8.6% on shareholders' money, and the highest return was given by ACC at 15%, followed by JK Cement at 13%. And the lowest RoE was again Ultratech itself, and it has also fallen below its 5 years average. If you look at ACC, its recent return on equity has increased or is more than its 5 years average of 11%, which is a good sign. Most of these peer group companies are earning less than 15% return on equity over the last 5 years period. Next, let us look at the growth rate in return on equity over the last 5 years. Ultratech's return on equity has been falling at the rate of 7.3% from where it was 5 years back. The maximum fall in RoE was seen for Ultratech at 15%. And the maximum gain in terms of making profit on shareholders' money was for JK Cement at 18% growth rate. Next, we'll look at the return on capital employed. This is the return that the company has generated over the period of 5 years on the total capital employed. Let us understand what is capital employed and what is a return. Return in this case is the EBIT, earnings before interest and tax. This is operating profit plus the depreciation, and we divide this by the capital employed into the business. Capital employed is, in this particular case, is composed of fixed assets plus the working capital. And from this fixed assets, we haven't deducted depreciation. So this is the total fixed assets including the depreciation. We want the return on capital employed for our companies to be above 15%. Ultratech recent or 5 years average return on capital employed was 12%. Highest return was given by Shree Cement at 16%, and other companies are around the same level of less than 14%. Let us look at the recent years return on capital employed. Highest return was again seen for ACC at 16%, followed by Ambuja at 15%, and the other three companies have given a return of less than 15%. We can also see how the current year's return on capital employed has increased or decreased over its 5 years average. For Ambuja and even for ACC and JK Cement, all three companies have managed to increase their return on capital employed of the current year above its 5 years average. Shree Cement and Ultratech's RoCE of the latest year has fallen below its 5 years average. Next, let us look at return on assets. These are different profitability metrics where we are trying to understand how the company has performed using different variables from the balance sheet, like assets, like borrowings, debt, and so on. So in this case, we are taking the assets as the total balance sheet size and removing out the current liabilities. And here we are trying to understand how the company has performed in generating profits on the assets employed into the business. This is the 5 years return on assets on average. Here we want it to be as high as possible. Ultratech's RoA over the 5 years average period was 6.8%. Highest return on assets was seen for Shree Cement, followed by ACC at 11%. JK Cement's return on assets was the lowest at 4.9%. So it is not employing or deploying its assets in a way that generates high profits. Next, let us look at the asset turnover. This is the metric which indicates how many times over assets were turned over into sales. In this case, the assets are the net worth of the company plus any borrowings. Here also we want it to be as high as possible. Ultratech's sales is below the assets employed into the business to generate the sales. So this is not a very good sign. We want it to be at least equal to the assets employed or more than the assets employed into the business. That shows efficiency of the management in turning over its assets into sales. The highest conversion of assets into sales was for ACC at 1.4%. Next, let us look at the current year's return on invested capital. This is the operating profit that the company has generated on the net block plus the working capital. Net block is basically the total assets of the company deducting the accumulated depreciation from that. So what we have is the net block and any working capital changes of the company. Here we want it to be as high as possible. The RoIC is used to understand ratios for those companies which have high investments in fixed assets or which are capital intensive. Ultratech's RoIC was 15%. Shree Cement gave the highest return on invested capital of 35%. Ambuja's RoIC was the second lowest at 17%. Other two companies have also given about 20% of RoIC. This concludes the profitability metrics. Next, let us look at the profit that the company has generated over the period of 5 years and how much of that profit has got converted into cash, that is against the profit that the company has indicated, how much cash the company actually received. Out of that cash that the company received, how much was invested into buying of fixed assets and how much was left over as free cash to be distributed to the shareholders as dividend or bonus or buyback or to pay off borrowings or prepay the borrowings that the company has taken in financing activities. These comparison will look at by looking at the CFO to PAT comparison, that is how much of the profit that the company has shown has got converted into cash and how much of the cash that the company has generated is used in buying of fixed assets. Ultratech has received 93% more than the profit that the company has shown in its P&L account. JK Cement has shown the highest cash inflows of 177% above its profits. That is, the profits shown was 1100 CR, against which the company received 3200 CR. That is 177% or 1.7 times more than its earnings. In terms of free cash flow, Ultratech utilized 42% of its cash from operations into buying of fixed assets. Shree Cement has used 87% of its cash into buying of fixed assets. Now, out of 9,000 CR of cash that it received, it has only 1,099 left over as free cash flow. That is, it has used up 87% of its cash. Here, I look for a usage in buying of fixed assets of not more than 50% of the cash that the company has generated. Ambuja has done well by keeping its investments in fixed assets at 40% of the cash that it has generated in the last 5 years. ACC has invested 61% of its cash into buying of fixed assets. And JK Cement has invested 56% into fixed assets. Next, let us look at the annual profit that the company has generated and compare that with the 5 years average profit after tax, and also compare the current profit with the previous year's profit, and also understand how the current year's profit has got converted into cash. This we will compare using the ratios PAT to PAT of 5 years average. That is, understand how the profit has grown over the 5 years average profit. Next, how the profit has grown from its previous year, and how much of the profit that the company has shown in the current year has got converted into cash. Ultratex current year's profit has fallen minor at 0.2% below its 5 years average. Even Shree Cement's current year's profit has fallen below its 5 years average at 4.5%. Ambuja ACC has shown a very high growth in its 2018 profit above its 5 years average. Since we don't have the 2019 values, we are considering 2018 in understanding the profit after tax compared with the 5 years average. JK Cement has also managed to grow its profit at 40% above its 5 years average. Next, let us look at how the profits have grown over its previous year. Ultratech's profit has fallen at 1.2%, a nominal drop over its previous year. Although I would like to see at least a 10% growth rate year on year in profits. Shree Cement has seen a big fall in its profit of 19%. Ambuja and ACC have grown their profits by 52 and 64%. Whenever we see such high growth rate in profits, we should make sure whether the previous year's profit was in range with how it was earning in the prior periods, or was there a major fall, and now because the profit has grown, the percentages have increased. Generally, we should not expect such high growth rate in profits. JK Cement has also seen a fall in its profit from its previous year of 8%. Next, let us look at the cash conversion. Ultratech has managed to convert our entire profit into cash, and it has received 119% more in cash than what it showed as profits. Ambuja and ACC in the current year, or 2018 for that matter, have shown a decrease in their cash collection than what it showed as profits by around 24% and 26%. Shree Cement and JK have both managed to collect more cash than what they showed as profits. Next, let us look at the quarterly growth rates in sales and profits. This is a year-on-year comparison, whereas this is sequential quarterly comparison. Ultratech has seen a growth in its sales from two previous quarters, that is from March to March, of 17%, and from quarter on quarter also it has seen a 16% growth rate. Most of these companies in the recent quarters have seen high double-digit growth rate, except for Ambuja and ACC, whose sales have been at a moderate level of around 5 to 7%. In terms of profit, Ultratech's profit has increased at a very high pace over its previous quarter by 61%. Shree Cement saw a fall from where it was in the previous quarter by 19%. JK Cement and ACC both saw a gain in their profits of 38 and 44% each. In terms of quarter on quarter profits, Ultratech and JK Cement have seen a triple digit growth in their profits sequentially, whereas Ambuja saw a fall sequentially from December to March quarter of 49%. Here we want the sales and the profits to be growing at least 10% and above. Let us look at the net worth. What is the size of these companies? Ultratech's net worth is 28,000 CR and Ambuja and ACC both are around 22,000 and 10,000 CR. So these are big companies. Even Shree Cement is a big company at 9,500 CR, followed by JK Cement at 2,800 CR. Next, let us look at the contingent liability of these companies. Contingent liabilities are those liabilities which may or may not arise in the future, and also there is no provisions done by the company for these kind of liabilities, and they are shown in the notes to accounts outside of the balance sheet. For me, I don't want the contingent liability to exceed 20% of the net worth. Ambuja, ACC and JK Lakshmi Cement all have exceeded 20% of their net worth. The contingent liabilities are high compared to their net worth. Ultratech and Shree Cement have seen a low contingent liability compared to the net worth. In fact, Shree Cement has the lowest net worth contingent liability of the peer group comparison. Next, let us look at the debt to equity ratio. This is the total debt that the company has taken against the equity shareholders' contribution. I don't want debt to equity to exceed more than 1 times. Whenever the debt increases considerably, the company also has to pay an interest cost on that, which eventually reduces the profit that the shareholders would expect. Ultratech's debt is 0.8 times of the equity contribution. Ambuja and ACC are debt-free companies. Even Shree Cement has a minor debt of 0.3 against the equity. JK Lakshmi Cement also has a 0.8 debt, same as Ultratech. Now, because Ultratech has a debt of 0.8, its interest coverage has fallen below 4 times, which is my criteria. Even JK Lakshmi's interest coverage has fallen below 3.2 times. Interest coverage is basically comparing the EBIT with the interest paid in the latest year. So here we want to understand what part of the EBIT or what percentage of the EBIT is occupied by the interest payment or interest expense. Or in other words, against the interest paid, what is the EBIT that the company has earned? So Ultratech's EBIT is more than 3.2 times its interest payment of the latest year. Since Ambuja and ACC didn't have any debt and they didn't have any interest payments to be made, the EBIT was 20 and 23 times more than whatever interest it paid. So we want the interest coverage to be more than 4 times, or we want the earnings before interest and tax to be 4 times more than what the company pays as interest payments or as finance cost. Next, let us look at where the profit was compared to the borrowings of the company. Ultratech's borrowings were 9.4 times more than the company's profit of the latest year. So we want these ratios to be as near as 1. That is, whatever profit that the company has made in the latest year, the borrowings are very similar to that or within that range. Ultratech will require at least 9 years of profits to pay off its entire debt if we consider that the company would pay entire profit in clearing of its borrowings. This is the highest in the peer group. JK Lakshmi's borrowings were 7.3 times more than the profit it earned in the latest year. ACC and Ambuja, since had no debt, their profits were entirely used to pay off shareholders in dividends or for buyback acquisition. Shree Cement borrowings were 2.9 times higher than this year's profits. We want these ratios to be as low as possible. Next, let us look at the promoter holding. This is the stake or participation of the promoters into the company's shareholding. It shows us how much the promoters have a stake in running the business well. Most of these companies have high promoter holdings of above 50%, which gives us confidence that the promoters would look to keep managing the company well and keep increasing the profits of the company, as they are the ultimate beneficiaries, as they are the major shareholders in the company. None of these companies have any pledge on any of their holdings, which is a good sign. I don't want the pledge to exceed 20% of the promoters' holdings. Next, let us look at the debtors and compare that with the current year's sales. Debtors are the accounts receivables or money still to be collected from customers till March 2019, and we compare that against the sales that the company has done in the latest year. This gives us an idea as to how much of the sales of this year was still pending to be collected from debtors. We want this ratio to be as low as possible and not to exceed 30%. That is, the collection from customers should not be more than 30% of this year's sales. All of these companies have managed to keep the debtors at less than 8% of their sales of this year. Next, we'll understand how fast the company is collecting payments or money from the customers. All of these companies are collecting money within 30 days of the credit given to the customers, which is a good sign. I don't want the collection period to exceed more than 90 days. When the company collection period goes above 90 days, it shows weakness or problem with the collection of the money from customers by the management, which is not a very good sign, because that ultimately means that money not coming into the business and company would have to borrow money for meeting its working capital requirements. Let us look at how it was collecting money from the customers 3 years back. 3 years back also, the collection period was pretty much the same at less than 30 days for most of these companies. The lower, the better, the faster the collection days, the better it is. Next, let us understand how the inventory was converted into sales, or what was the multiple of sales that the company generated on the inventory it was holding. Ultratech has converted its inventory 10 times over into sales. Inventory is the raw material, finished goods, or work in progress that is shown in the balance sheet at the end of the year. Against that, what was the sales that the company has managed to generate? Shree Cement has turned over its inventory 7.4 times over into sales. We want these ratios to be as high as possible. And if one of these companies are showing a low turnover, that would indicate a kind of a weakness for these companies. We can also compare the current year's inventory turnover with its 3 years prior inventory turnover and understand how well the company has managed to grow or convert inventory into sales. Shree Cement's current year inventory turnover has fallen below its 3 years inventory turnover. Ambuja also has seen a fall in its current year's inventory turnover, and so on for the other companies. Next, let us look at the 5 years operating profit margin that the company has made during the last 5 years on average. I want the operating profit margin to be more than 15% at least, which shows that the company can comfortably make at least an NPM of 10%, provided the OPM is somewhere around 15% and the interest cost or the depreciation is not very high. All of these companies have made a 15% and above OPM except ACC at around 13%. Now, how much of this OPM has got converted into the net profit margin needs to be seen. So, in the latest year, Ultratech's net margin was 6.5%, way below the 10% benchmark that I've kept. The 5 years OPM was very good at 19%, but the current NPM has fallen steeply below 10%. Other companies like Ambuja and Shree Cement are nearby to 10%. Only ACC has managed a 10% of net profit margin. When we look at the previous year's net profit margin, that is 2018's net profit margin, and compare it with the 2019 net profit margin, we observe that Shree Cement is the only company in 2018 which has managed about 10% of net profit margin. This indicates to us that most of these companies are not able to garner or sustain a very high or generate a very high profit margin on their sales. So there is a lot of pressure on these companies and not able to convert most of these sales into revenue or profit for that matter. Next, let us look at the current ratio. This measures the liquidity of the company in paying off its short-term obligations or short-term current liabilities. We want these ratios to be at least 1 and above, which would indicate then that these companies are in comfortable position to pay off their current liabilities using their current assets. All companies have a good position of above 1 except Ultratech, whose current and quick ratio are below 1, which would indicate to us that the company's current assets are not enough in case of liquidation or in case of completion of 1 year to pay off those liabilities which needs to be paid within 1 year. All of the companies have managed to keep it above 1. Quick ratio indicates how quickly the company can convert its current assets into cash and pay off the current liabilities. Next, let us look at the gross block. This is the total assets of the company valued at their cost of acquisition, and after removing depreciation from that, we get the net block. That is the fixed assets that the company finally owns, or the value of fixed assets after removing depreciation. And what is the depreciation charged on the net block? This comparison will use through ratio accumulated depreciation to gross block, or what is the percentage of total depreciation accumulated on the gross block, which would indicate to us how much of the assets are still left over to be depreciated over the future years, and what is the depreciation rate charged on the net block, which then would indicate to us whether the company is in range with the peer group companies in reducing their assets. Ultratech's total depreciation on their gross block is 12%. Here, the higher the better, because that would indicate that only the remaining assets are still needing depreciation, and the depreciation would clear off within next few years, or the depreciation would not affect the P&L account going ahead in the future years. The lower the depreciation, accumulated depreciation percentage, the more it still needs to depreciate over the future years. Ultratech's depreciation or accumulated depreciation was just 12% of its total gross block. That is, of the assets that it owned of 52,000 CR, its accumulated depreciation was just 6,400 CR. It still needs to depreciate 46,000 worth of net block over the future years, which it is doing by depreciating it at the rate of 2,000 CR every year, which is 4.6% of the net block. In this case, only Shree Cement and JK have above 30% of accumulated depreciation to the gross block. And in terms of depreciating assets, Shree Cement is depreciating its assets at the fastest rate of 31%, which needs to be checked why they would depreciate at such high rates. Of the net block of 4,400 CR, the depreciation in the latest year was 1,392 CR, which works out to 31%. Other peer group companies are in a range of less than 10%. In terms of dividend yield, or how much dividend the company paid based on the current price, we find JK Cement to be giving the highest yield at current price at 1%. Ambuja is not paying any dividend, at least not in the latest year of 2018. This concludes the analysis of these companies. Let us again go through all these ratios and understand which companies have done best in which ratios. I have color coded all the ratios, and the green indicates the best score for that particular ratio, whereas red indicates that the company has performed poorly. All the companies' face values were 10. None of the companies have done any split of their shares except Ambuja, which has a face value of 2. The highest fall was seen in Ambuja and ACC from their 52 weeks back price. The fall was around 12% for each Ambuja and ACC. The lowest fall was seen for Shree Cement at just 5.6% from 52 weeks back. And Ultratech's fall was just 7.8% from where it was, or from where the price was 1 year back. In terms of earnings yield, that is, what was the profit that the company earned on the share price, the lowest yield was seen for Shree Cement as well as Ultratech. The company had earned 88 rupees. Ultratech had earned 88 rupees on each share, but the price was very high at 4,500 rupees. Therefore, the yield dropped to just 2%. Same thing is for Shree Cement. The price is very high at 21,000, whereas the earnings per share was 273. The highest yield was seen for ACC at 6% on a price of 1544. Company had earned 92 rupees. And the second highest yield was for Ambuja at 5.4%. In terms of price to earnings, or where the price was compared to the company's earnings per share, the best price earning valuation multiple was for ACC at 16 times and Ambuja available at 17 times its earnings, the lowest of the group. The highest price earning multiple was for Ultratech at 52 and Shree Cement at 67%. So we would not want to buy shares when they're trading at such high valuations and multiples. In terms of 5 years historical price earning, the best multiple from last 5 years was for JK Cement at 28.3 times, the lowest of the group. Even this is high because we want it to be below 25 times at least. But historically it has been, all these companies have been trading at a high premium. Ultratech and Shree Cement were historically at a very high premium of 39 times. And in 3 years, that is the last 3 years, historical price earning was also very high for both Ultratech and Shree Cement. The best one again in this case were Ambuja and JK Cement, available at slightly above 30%. In terms of price to operating cash flow, or where the price was compared to what the company earned through operations, the best available was JK Cement, where the multiple against the OCF was just 10 times. That is, the price was 10 times higher than the company's cash flow from operations. Ultratech was also available at a reasonable 24 times, although this is also very high because it's very near to our benchmark of 25 times. And the highest price to OCF ratio was for Shree Cement at 35 times and ACC at 25.9 times. So these two companies in terms of cash were quite high. In terms of free cash flow also, the highest valuations was for Shree Cement, where its free cash flow was very minimal. That is why the price to FCF was very high at 421 times. Here too we wanted below 25 times, but as we see, none of these companies are trading at such valuations. So the best available was Ultratech at 34 times and ACC at 46 times. Even JK Cement's free cash flow to price was 71 times. In terms of book value, Ultratech and Shree Cements were trading at a high premium to its book value of 4.4 times for Ultratech and 7.7 times for Shree Cement. The most reasonable price to book value was for Ambuja, available at just 1.9 times its book value. JK Cement was available at just 2.6 times its book value. Here the threshold is 2.5 times or less than 2.5 times. In terms of where the price was compared to the sales per share, we see that JK Cement's price was just 1.5 times its sales, whereas Ambuja's was just available at 1.6 times its sales. So these were at good valuation. The Ultratech and Shree Cement is trading at a premium to its sales at 3.3 for Ultratech and 6.3 for Shree Cement. So these are high valuations. We want it to be as near to 1 as possible. That is, the market cap has to be as near to the sales as possible so that we get a good buying price for the scrips, or we enter at a good price valuations. In terms of growth in profit over both 5 and 3 years, JK Cement saw a good profit growth rate for both 5 and 3 years at 27% and 47%. Ambuja also saw a good growth rate of 13 and 47%. The lowest fall or the lowest profit growth was for Ultratech and Shree Cement. Although they were trading at a high valuations, their profits didn't justify that valuations, because the profits over a period of 5 years was just growing slightly above 3% for Ultratech, and Shree Cement was 3.7%. In fact, in the last 3 years, the profit saw a degrowth for both Ultratech and Shree Cement. In terms of price earnings to growth ratio, which I have already explained earlier, the best available in terms of price earning compared with the profit growth was JK Cements, which had a PEG of 0.9 and 0.5 for both 5 and 3 years. Even Ambuja was at a good valuation of 1.3 and 0.4. We want the PEG to be below 1.5 at least. So these are good valuations. Compared to that, Shree Cement and Ultratech's PEGs were very bad at 17 and 20 times. PEG for 3 years were negative because the profit growth were negative for the 3 years. That is why the PEG also turns negative. Next, sales growth rate. Sales growth rate was again very good for Ambuja at 23% and 40% over 5 and 3 years each. Even Shree Cement had a good growth rate in sales of 16 to 28, but it didn't translate, or it couldn't translate that into profits. Whereas if you see, Ambuja's sales had grown at a good rate, as well as the profit has grown at 13 and 47%. The worst sales growth was for ACC at the minimal 6% and 8% growth rate, followed by JK Cement at 12 and just 6.5% growth rate in last 3 years. Here we want the growth in sales to be at least 10% and above. In terms of return on equity over the 5 years and even the latest year return on equity, we see that Shree Cement has given a good return on equity over an average period of 5 years above 16%, which none of the company has managed to give. Even JK Lakshmi Cement's ROE was good at 12%, although it's still below 15, which is the benchmark. The worst ROE ratio or return on equity, that is the profit that the company has earned on shareholders' money, was for Ambuja, which earned just 8.9%, the lowest in the group, followed by Ultratech at 10.3%. In the recent ROE, that is 2019 ROE, The best was ACC at 15% and JK Cement at 13%. And the lowest return on equity was seen for Ultratech as well as Ambuja at 10% and 8.6%. Again, these companies have performed poorly in average as well as in the latest annual returns on equity. In terms of return on equity growth rate over a period of 5 years, we see JK Cement is the only company which has managed to grow its return on equity at the rate of 18.3% year on year, followed by ACC at 1.8. Rest all the three companies have seen a fall in their return on equity ratio over a period of last 5 years. In terms of return on capital employed over the period of 5 years and even the last year, we see that both Ambuja Cement has done very well in terms of return on capital employed, although over the last 5 years the average is 14%, although we want it to be slightly above 15. In that sense, only Shree Cement has managed above 15% growth rate in return on capital employed over the period of 5 years, and it has done poorly in terms of the recent RoCE of 2019. ACC has managed to do well in the latest year of earning a return on capital employed of 16%, along with Ambuja, which earned a return on capital employed of 15%. Ultratech's return on capital employed was poor at 12% and 10%, and even the recent RoCE is below the 5 years average. So it has performed poor. Even Shree Cement's recent return on capital employed compared to its 5 years average has fallen down to 12.2% compared to its 5 years average of 16%. Let us look at the return on assets and assets turnover. Ultratech Cement's return on assets is very poor, along with JK Cement at 4.9, which is the lowest in fact in the group company. And how much times was the assets converted to sales was very poor for Ultratech and Shree Cement. Both have done poorly. That is, whatever assets they had employed into the business, they could not manage to convert that into multiple of the assets that was working for the company. In that sense, ACC has done well to give a return on assets over a period of 5 years at 11%, and even Shree Cement has given a 12% RoA. Although its asset turnover was very equivalent to its, that is, the sales were very equal, it was equal to whatever assets were employed into the business, but in that sense, Ambuja and ACC have done much better in turning over its assets into sales, slightly above 1%. 1 times. Next, let us look at the return on invested capital. Shree Cement has given a return on invested capital of 35%. Why these ratios are high is because RoIC does not consider or deducts depreciation from the denominator in calculating the ratio. Therefore, we see high RoICs. Even in that sense, Ultratech has managed a poor return on invested capital of just 15.17%. Shree Cement has done the best at 35%, followed by ACC at 24%. Next, let us look at how much of the profit was converted into cash over the period of 5 years, which gives us a fair idea as to how the earnings has been converted into cash. Ultratech has received 93% more than its earnings in cash, along with JK Cement, which has received almost 1.7 times or 177% more than its earnings. That is, the cash coming in through operations was 177% more than the profit. Shree Cement and ACC both have done poor in terms of converting its earning into cash, although this is still better because it's not negative, it's not less than the profit. Shree Cement's cash coming in was 58% more than its profit. That is, it received a cash of 9,100 CR against the profit of 5,700 CR. So that's equivalent to 58%. This is also good. ACC has done poor at 38%. From 4,969 CR as earnings, the cash coming in was 6,800 CR, which is equivalent to 38%. Although I would consider these values also as positive. Next, let us look at how much of the cash coming in through operations was used up in buying of fixed assets. We want the ratio to be below 50% or less than, not to be more than 50%. Ultratech and Ambuja have done the best, that is deploying 50% of its cash, less than 50% of its cash into buying of fixed assets. All the other three companies have invested more than 50% of their cash into buying of fixed assets. Shree Cement has utilized maximum of its cash from operations into buying of fixed assets. Now it has just 1,099 left over for use in financing activity. Next, let us look at the profit and how the current year's profit stacks up against the 5 years average profit after tax value. JK Cement has earned 40% more than its 5 years average profit, followed by Ambuja, which earned 75% above its 5 years average, which is a good sign. Ambuja also had a year-on-year growth rate in profit of 52%, that is from 17 to 18. 2017 to 2018 there was a YOY growth in profit of 52%. ACC saw a growth in YOY profit of 64%, whereas Shree Cement fall a 19% drop in its YOY growth in profit. Even JK Cement saw a fall in its profit. In terms of profit over a 5 years average, Ultratech had a fall, in fact its profit fell below its 5 years average. Even Shree Cement saw a fall below its 5 years average by minus 4.5%. Although this is minor, but we would like to see the latest profit to be above the 5 years average at least. So that's a good sign to look at. In terms of how much of the profit was converted into cash in the latest year, Ultratech has managed the highest return, 119% more than what it showed as profit. That is, out of 2349 CR as profit, 5160 came in as cash, which was 1.1 times more than its earnings. JK Cement also saw a CFO to PAT of 115% more, which is a good sign. Both Ambuja and ACC in the annual cash conversion saw a drop of 24% and 26%. That is, cash coming in through the operations fell short by 24% of its earnings, or whatever earnings the company had shown, 2390, but the cash came in was only 1727. We want these values to be positive. Next, let us look at the quarterly sales growth rate and profit growth rate. The highest sales growth was seen YOY for Ultratech at 17% and Shree Cement at 16%. Ambuja and ACC saw a minor growth in their sales YOY at 5.8 and 7.8% each. In terms of profit, Ultratech's recent quarter profit is very good at 61%. Although Shree Cement saw a fall in its profit, although their sales increased, but their profit dropped by almost 20%. JK Lakshmi saw a growth in its sales as well as growth in its profit. So this is what we are interested in looking at. In terms of quarterly sales and profit growth rate, 17% growth rate in sales for JK Cement and a profit growth rate of 146%. Whereas Shree Cement has done poor, although their sales has increased sequentially from quarter on quarter, the profits has not grown accordingly. at just 6.5%. Next, let us look at the net worth, the size of the company. Ultratech and Ambuja are the two big companies in the group, and the lowest valued company were JK Cement and Shree Cement at 9,597 crore. Contingent liability was very high for JK Cement at 39.6%. Even Ambuja's contingent liability to net worth has increased about 20%, as well as ACC's also has increased about 20%. We want the contingent liability to not exceed 20% of the net worth. In that case, Ultratech and Shree Cement have managed to keep it below 15 times or 15%. In terms of debt to equity, most of these companies are trading at a good debt to equity ratio of below 1, although JK Cement and Ultratech have a high debt to equity of 0.8 compared to the other three companies which have very negligible debt. Accordingly, the coverage was also very poor for Ultratech at just 3.2 times its EBIT, and even debt was 9.4 times its profit. So these are very high values because there's a high debt. Same was the case for JK Cement. Because the debt was high compared to the equity, the coverage was down to 3.2 and the debt was 7 times higher than its profit. ACC and Ambuja had the best ratios for debt to equity, interest coverage and debt to profit. In terms of promoter holding, most of these companies have high promoter holdings of above 50%. The highest promoter holding was seen for ACC as well as JK Cement. Shree Cement and Ambuja Cement had also high promoter holding. I have corrected the ranking. Shree Cement and Ambuja have the highest promoter holdings, and the lowest promoter holding was for ACC and JK Cements. None of the companies have pledged any of their shares, so that's a good thing. The debtors, compared to the sales that the company did this year, most of these companies have managed to keep their debtors at below 8% of their sales of this year, which is a very good sign. But the highest debtors was seen in ACC at 7.8% of sales and Ultratech at 6.8% of the sales. The lowest debtors were for Ambuja and JK Cement. Debtor days is the collection that the company does from its customers. The fastest collection was seen for both JK Cement and Ambuja at 15 days and 18 days. Even 3 years back, both the companies have performed very well of collecting payment from its customers within 11 and 14 days. Ultratech and Shree Cement both are taking high number of days, although this is still okay because it's less than 30 days. We can give this a pass. In terms of converting inventory into sales, Ultratech has done well in the recent year of converting 10 times its inventory into sales, followed by JK at 9 times its inventory into sales. 3 years back also we saw Shree Cement has done well at 8.1 and JK again at 8.1. So both of these companies have done well of converting inventory into sales. In terms of 5 years operating profit margin, the highest margin was seen for both Shree Cement and Ultratech, but the same could not be converted to the net profit, which fell below 10% for both each of them. In terms of 5 years OPM, ACC and JK saw a low OPM margin. Even then, ACC has managed to keep its NPM of about 10%, which was the highest in the recent year. Although this NPM is of 2018 and the Ultratech and Shree Cement have a 2019 NPM values, but as far as comparison is concerned, ACC has done well, although it's not strictly comparable with the other three companies. Net profit margin in the previous year to that was highest for Shree Cement at 14%. That is, in 2018 it had earned 14% NPM, and in 2019 the OPM fell to 8%, which is again not a very good sign. We want the NPM to be at least equal or growing year on year. In terms of quick ratio and current ratios, Shree Cement had the best asset quality to pay off its current liabilities, followed by ACC, and Ultratech's assets were not enough to cover its current liabilities, and that could create a problem along with JK Siemens. In terms of accumulated depreciation, the highest accumulated depreciation was for Shree Cement at 49%. Most of its gross block was already depreciated. Now its net block is just 4400 CR, and it's depreciating that too at a very high pace of 31%. Ultratech's accumulated depreciation is just 12% of its net block, and it's also depreciating at a very low rate of 4.6% every year. In terms of dividend yield, highest was seen for JK and ACC. Ambuja has not paid any dividend in the last year, that is 2018. So this concludes my analysis for all of these companies. The highest score was seen for JK Cement at 176 points, followed by ACC and Ambuja at 168 and 164 points. Now, to conclude this, in terms of efficiency metric, how efficient the company was in managing its different resources, the highest score was seen for ACC and JK Cements. In terms of solvency, Shree Cement was the best available in terms of solvency along with ACC. In terms of cash flow metrics, Ultratech has done the best, followed by JK at 4 or at 12 points in total. In terms of how well the company has managed to grow its profits, Ambuja and JK Cement have done very good at growing their profits year on year as well as 5 and annually. In terms of return metrics or profitability metrics, Shree Cement had the highest score in terms of profits. ACC also has done well at 41 points. In terms of valuation or how cheap the stocks were, Ambuja and JK were available at a very low valuations compared to different metrics which we saw earlier. Ultratech and Shree Cements are available at a very high valuations, and I've got the lowest scores. To finalize, JK Cements has got the maximum points of 24 in terms of grouping with different metrics, followed by ACC and Ambuja. So it has matched with what was shown in individual metrics as well. Thank you for watching this video.